This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm Riddhi, and today I'm joined by Charlie Viola, Executive Chair at Viola Private Wealth, a firm he founded in 2024 that now manages over $2.5 billion for high net wealth individuals and their families. Welcome, Charlie.
Hey, Riddhi, how you going?
I'm good.
I need to update our marketing. I think we're just over $3 billion now.
Oh, $3 billion. Okay. So that's an update for everyone. Charlie, I spoke to you recently for the platforms feature. For our listeners, that's now available to read in our latest newspaper edition. At the time, you mentioned that a lot of wealth firms are now moving their entire books onto platforms, whereas for Viola, you're still running about 2/3 of your clients off platform. You call yourself a bit of an old school. So can you walk us through that thinking? What's your thinking in terms of that?
Yeah, we just take the view that we want to be agnostic from a product point of view and from a platform and an administration point of view. So what's probably really important to us is that whatever the client situation dictates is how we manage their money. So there will be, for some people, that the use of a platform, NetWealth, Hub24, CFS Edge, whatever the platform might be, may well be very appropriate for that client, and the investment constraints associated with those platforms will work very well for those clients. And it may well just be because of where we've come from and the fact that we've managed lots of money off platform non-custodially for a really long period of time. But we really want to give the advisors the ability to make the best decisions they can for their clients in the context of whatever it is that their clients are seeking to achieve. What I would say though, and while the business, while we did the management buyout back in October 24, it really is the same business that we've sort of had for the last 20 odd years. These platforms have come like so far over that sort of 20 odd year period, right? Like the functionality, the usability, the efficiency, the cost, the access to product, the ability to kind of put non-core assets on there. We pride ourselves at Viola Private Wealth around being very much an investment business, and we're reasonably well known in the market for seeking out really good, alternative non-core strategies for clients to try and produce better returns, reduce the risk, especially reduce the drawdown risk. There was a long time that those type of investments and that institutional style of investing wasn't available on the platforms. It now very much is. Yeah, we just want to be agnostic. We just want to make sure that we're doing the right thing by the clients.
Is that also because it helps you access alternative investments easily?
Yeah. So like I say, I think in truth, lots of those investments are now available through the platforms. But traditionally, when we were thinking about how we were building out client portfolios, because we were accessing alternative investments, because we were accessing investments that were institutional grade, it was a means that we had no other option but to be off platform and to hold, these kind of bespoke style assets the way that we were doing it. What's happened over the last 15 or 20 years is that, these private market investments, and we try not use the word alternative because alternative makes it sound like you're putting money into a Guatemalan coal mine or something when you're really not, right? Like they're just normal assets wrapped up in a different way. Access to private markets in the past was really only something for institutional investors, family office style investors, whereas now it's been so heavily democratized that really any high net wealth individual can access these in a wholesale format. Even if we go back, 5 or 6 years, it was still only available via IM off platform. Lots of those now, and as the platforms have developed their systems and created better efficiencies, they are available on platform more and more. It's just from our perspective, we just want to make sure that we're giving ourselves all of the opportunity to invest in all of the things that we see fit for our clients. And we work really hard to be in the deal flow and then do really good due diligence to try and produce those, good long-term, outsized returns.
Just taking to private markets, global equities have had a phenomenal run in the past few months. They're liquid, they're cheap, they're simple. How are you looking at private market investments compared to
global
equities?
Yeah, we're a big one for asset allocation. So we're a big one for strategic asset allocation. We work really hard around building parameters within client portfolios to, protect the risk, be really well diversified. Global equities continues to be a core part of every client portfolio. We are a big believer in global growth. We saw on the weekend, I think that the NASDAQ is now probably the cheapest it's been from an earnings point of view over the last kind of 3 years or so. We're going to continue to kind of put client monies into global equities. We tend to kind of look at equities as one bucket as opposed to Australian equities and global equities. And, our benchmarks generally for a normal client will be anywhere from sort of 35 to 45% in equities. And, we are getting to the point where we are getting pretty close to the maximum that we can put in, and especially global. We're a believer in global growth. We do think that that's going to drive returns. So just because we're accessing private markets for, private debt, private credit, private equity, infrastructure, zero beta alternatives, we still like global shares. We still think that's where growth is going to come from, and we'll continue to use them.
Private markets, in terms of your allocation, percentage of allocation, what are you looking at right now? And do you think that's going to sort of expand or contract in the coming years? Do you have any sort of thoughts on that?
Yeah, we've been a big user of the private market space for a long time, and it's probably been one of the differentiating factors of our practice and the way that we manage money. We probably like, again, we go back to this kind of philosophy of asset allocation and strategic asset allocation. Once a client's portfolio is fully deployed, we want 5 to 10% of their money in private equity. We like it. We know it's longer burn, but ultimately it's where the best returns should come from. We still like the private debt, private credit space. We just don't want to, overdo the kind of CRE and the property stuff. But in reality, we want 10 to 15% of client monies in there. It's a good, the risk tends to be a bit asymmetric to the return. It's a good way to kind of pump cash into client bank accounts. And then, equally, we want sort of 10 to 15 to almost 20% in real asset style investments. And that's often dominated by infrastructure. We like infrastructure. We like the fact that it punches cash into the bank account. We like the fact that it's inflation protected. And now, again, because of that sort of democratization piece of this private market stuff, what we're finding is we've got access to the best managers in the world. So, we've got access to KKR, Hamilton Lane, CVC, Schonfeld, all managers that, 15 years ago, groups like us, where, our average client at Viola Private Wealth is probably that client with, 15 to 70 mil of investable monies, just couldn't access these types of investments.
Very interesting. You mentioned the investment manager's point. One of the biggest things for an advisor is to pick the right investment manager, right? That's the big task of an advisor. What are the sort of red flags and green flags that you look out for when you're picking the right investment manager for your clients?
Yeah, if I wanted to hone in on any kind of, differentiating factor of us as a practice is the deep level of due diligence that we do around manager selection and fund selection. Picking the right jockey, because that's what you're doing. When you're going into private markets, you are picking the jockey. So picking the right jockey becomes the absolute key piece. So we have a really well-defined due diligence process where we do go through a process of screening them first. So we have 5 or 6 kind of initial questions. Any red flag, to use your terminology there, that comes up off the back of those 5 or 6 initial questions, we'll just simply put a line through them or seek not to use them until they address that issue. So, we want to know that the manager is commercial to start with. We want to know that, and because, what's probably happened over time is once was an investment banker, now as a private credit manager, for instance, they all go off and they ran balance sheet money for big institutions and decided they had enough money and decided to go run their own money. And then they lean over the fence and they ask the guy next door for some money and they ask their friends and family and they ask but we want to know the manager's commercial. We want to know that they're actually going to be around for a period of time. Secondly, we want to know that they can articulate to us what their selection process is. We've all heard the PE manager come into the office and tell us that they see 4,000 opportunities, invest in 4, right? Like it's a well kind of said and known, filter process that they talk about. We want to see their process. We want to see what screens they're actually using, and we want to see real examples of them doing it. And then thirdly, we want to see the workout. So we want to see what happens when it all goes pear. So if we are a private debt manager and that private debt manager's lent money against a pub and the pub's burnt down, then we want to know what's happened. We want to know what happens when the debt steps into the shoes of equity. So we want to see what the manager does when it all goes wrong, because ultimately what we're trying to do is protect the client's money. So we want to know that they've got the same view in terms of protecting our client's money And the last one is we want to know that there's skin in the game. So we want to know that the manager themselves has either got balance sheet or personal monies invested in the strategy. They've got to eat their own cooking and they've got to be unequivocal about it. And then we just want them to be true to label. So if you are going to be a VC manager in the tech space, go and be a VC manager in the tech space and leave everything else because we'll find our other allocations elsewhere.
Yeah.
So once we're through that initial kind of screening process, making sure they are who they say they are, they're going to be around in 3 or 5 years' time, and they've got the commercial capability of being around, then we'll assess as to whether or not they've actually been able to achieve what they've said they've been able to achieve. We are very lucky now that we're able to access some of these, giant managers from around the world that have been around for years and years and years and been able to produce exceptional returns for a long period of time. Partners Group that have been around for 30 or 40 years, KKR for 50 years, Hamilton Lane for 30 years. These great managers that are now giving clients like ours access to these investments that just we weren't able to do 10 years ago. People often will say, because we'll show people that the returns that we've been able to generate for our clients over the last 15 or 16 years, markets have basically done nothing but go up over 15 years. Since GFC, we've had markets do nothing but go up. We've had, emergency low interest rates for a really long period of time. We've had, asset values roaring their heads off. We've had multiples kind of blowing out. And clients will generally ask, well, it's fine that you've been able to do it over the last 15 years, but can you do it over the next 15 or 20 years? We make the argument that we think we can produce better returns over the next 15 or 20 years at a lower level of risk because we can now access a different type of investment. So while all of the return that we've got in the past was being rewarded for the risk that we were taking in equity markets, we can now generate a similar style of return without the same level of risk. And we think that's actually a really compelling proposition for investors moving forward.
That makes me feel a bit positive about the future. So that's good.
The future is always positive. It doesn't matter what's coming because we're not there yet, right?
Yeah.
Like this is what life's all about. It's about being on the journey and learning.
Moving a little bit to the big changes that we're seeing in Australia, big tax changes. We've seen the Div 296 tax come in, the capital gain tax changes. Are you getting any panic calls from clients?
The panic calls have probably died down.
Okay.
There is certainly question marks in terms of what future structures will look like. So, to break those two things apart, Div 296, is reasonably sensible, right? So we have no great concerns about people that have got more than 3 mil and less than 10 mil having a tax rate on their superannuation money at 30%. We think that's kind of fair enough. And we think that's a fair enough contribution to the public purse, given the level of capital those people have got. In terms of the changes that were announced in the most recent federal budget, again, we're probably of the view, and I'm on record as saying, that the 30% minimum tax on distributions from trust is fine. It's sensible. If you've got enough money to have a trust, and remember, you need to have enough capital to use those types of structures, then 30% is absolutely fair enough. And it's kind of the tax rate people were paying anyway because they were distributing excess income down to bucket companies or beneficiary companies. Where we have concern and where we've seen concern is effectively the double taxation when you have the trustee or the trust pay tax and then you distribute it down to a company and you have another 30%. So that will kill discretionary trusts because ultimately it will mean that all of the income has to go out to individuals. You end up having to pay the top-up tax if you're distributing out too much. So if the way the rules are written currently become law, then there is a huge amount of rework that has to be done in terms of people's capital within trusts to the point where if there is sufficient capital in that trust, we're likely to have to loan that money to a company and try and attract the 30% tax rate that way. It'll be a cluster. It will be so very difficult from an admin point of view to make that work. We've explained that to clients. We've told them that we're going to sit on our hands and wait and see what happens over the next sort of 12 months as this kind of works its way out. We've seen the most recent consultation paper. We still believe they've missed the mark on understanding how it works. So clients aren't panicking. We've told them we have it in hand, but the reality is if it comes about the way it is at the moment, there is just so much administrative burden on groups like us to make this happen.
Are there going to be any changes in how these structures are built, or is money just going to start moving offshore?
I'm not so sure about money offshore. It's certainly not a solution that we think about, if I'm really honest. In the past, I've been very open in saying that the Australian tax rules are really simple, easy to understand. We have 4 tax buckets, right, in which you can invest money. You can invest in your individual name, a company, a trust, or super. All pretty simple, all have their own defined, sort of tax that you pay depending upon where you kind of put the money in which bucket. I think what happens is the trust bucket becomes dead and we probably end up using companies more than trusts moving forward if the rules are the way they are today. What are we doing right now? We're probably not changing our strategic direction just for the moment, but we will change it if the rules kind of hold the way they are. And it is a new way of thinking. And, even the spiel that I give to a client when I get up on a whiteboard and I draw them pictures, I need to draw new pictures. So there's retraining that's required for all of us.
So just the last question. You've left a big organization to start your own firm. For advisors listening, what's actually a good home for advisors? Would it be a big licensee? Would it be a boutique firm? Would it be building something yourself? Any sort of advice for advisors listening?
We were really lucky, right? We did a management buyout. So, the business that I had worked in and built for 20 odd years, we were able to sort of pick up the clients. We bought the entity itself. So, we bought the systems, process, infrastructure, governance, resourcing. We took it all with us and enabled us to kind of, we were a 20-year-old startup for want of a better term.
Yeah.
In terms of where advisors go, I do think that is quite advisor specific. If you are an advisor who is very entrepreneurial, have a great ability to create centers of influence, have a great ability to, create your own work, go somewhere that's going to reward that and go somewhere where you're going to get a greater share of it because you deserve it, because you are the value. Where you're an advisor who you feel like you are great at providing client service, but don't really want to get out with, 2 feet in a heartbeat and knock on doors and build your own centers of influence, go somewhere that can create the work for you. You're going to have to expect that if you're that you're going to receive a slightly lesser share of the revenue that you produce or get paid slightly less because the value is the brand that you're working for. So I think it's one of those things where it will be horses for courses and there is roles for all of us in this world. We read a stat the other day that in the high net wealth market, there are something like 650,000 people in Australia with a net wealth position or a net investable position of $5 million plus. There are only something like 50,000 that are actually being advised. So our addressable market is huge. These are great businesses to work in. These are great jobs to have and they're great businesses to own because you've got more people who need it. You've got less of us who are doing it. You've just got to find the right home that really supports where your talent is and where your passion lies in terms of what you're actually trying to do. What I would say though is the solutions that you provide around the investments becomes the key and pivotal thing in terms of being a really good advisor. The better the infrastructure around the investment making decisions, the better advisor you will become because ultimately the clients want good quality returns over a long period of time because there has to be no false economy in what we do. We have to produce good investment outcomes or the client shouldn't be paying us.
That was a great conversation, Charlie. Thank you so much for joining me today.
Thanks, Rudy. Appreciate it.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.